Morning, everyone. Welcome to class 11 of our financial data science course. We are now really approaching the last or the finale of the course. We started last class to talk about state-of-the-art literature that uses supervised learning to just turn off the light here. So we see it better. Okay. I showed you state-of-the-art literature for how supervised learning is used to predict stock returns and equity returns, and I've discussed that in detail on how, looking carefully at the results, you kind of already note how important is regularization versus feature scaling versus just pumping in all of the features relative to do some thinking. And today we continue that route, and we talk about two very interesting papers. These are the papers I like the most in that field as of now. It's this third button here. So reinforcement learning will be next week and the week after. And today, I think it's, from my perspective as a researcher, it's the most exciting class. First, you see, I will present the papers, which are state-of-the-art, and you will note how well it aligns with all the concepts that we've covered in class. I will also, while talking about the papers, introduce a bit of additional theory, which is necessary to really appreciate a paper. And nice thing about the paper is, the first one I talk about, it's also going to compare its performance, which is based on economic domain knowledge, let's say, relative to a pure linear and neural network type exercise. So that's really great, since it's the same data set, and we can really see what's the value of using domain knowledge. And the two papers in comparison that I talk about today also sharpens your intuition about what's the reason for predictability. Is it a risk premium or is it mispricing? How to measure both and how to model both. It's part of the papers. And we've talked about these concepts on the site, and today it becomes very explicit. Good. As usual, I'm very critical on the empirical assessment, giving you my personal view on how I think the findings fit in. Whenever you have a question, just interrupt me, right? That's very important. So we talk about two papers from Pelger and his co-authors. So it's a very interesting researcher. He studied economics in Bonn and then also mathematics, kind of halfway through. And then he did a PhD in Berkeley with Martin Lettau, who is a former KIT student for industrial engineering. And now he's in Stanford in the applied math department, doing machine learning. It started off with finance, but I think it's very broad now, going in all types of fields. And he has two papers published in Management Science. One is deep learning asset pricing. So therefore we will learn and deepen our understanding of asset pricing. And he has another paper, deep learning statistical arbitrage. So that will be very interesting to present them on the same day. Kind of the data set are similar, but not the same. So it's very interesting. So we start off with this first, deep learning asset pricing. Yeah, so deep learning refers to, we have several layers, most likely of some neural network, and then it's about asset pricing. So think about, what do you know about asset pricing? We know our first class, we had a golden growth model. So the price equals discounted cash flows, expected discounted cash flows, we discount by the risk-free rate and the discount rate, right? So every price of any type of asset is determined by expected cash flows divided by the discount rate. And that's exactly what he's also imposing here within his machine learning setting, which has the goal to predict returns 1 month forward. So it's the same exercise than last class, just now the methodology will be framed into this, I call it for you guys like Gordon growth type setting, yeah? But after today, or after the next 15 minutes, I just call it the asset pricing paradigm. Good. So the agenda is like in the last paper, I talk about the data in a nutshell. Then I introduce, as it's necessary for the paper and very much related to what we've done already, I introduce the stochastic discount factor approach to asset pricing. Here's also the reference to the asset pricing class we offer at KIT. So if you want to go revisit the material and go deeper for a full semester, then the asset pricing class is something for you. I then also talk about learning in a nutshell, how it works in the paper, and we talk about the empirical findings. And keep in mind, here the asset pricing theory is, in my interpretation, used as a regularizer. Yeah? So you know the classical regularizer, maybe of penalizing parameters, like in the elastic net, but here you will see there is an economic theory put on top, and if the theory is not too bad, it does regularize pretty well, and it really works out. Otherwise, we would not talk about that. Okay, so the data in a nutshell. So the authors use 46 stock characteristics and the cross-sectional median of each characteristic. So these are the stock-specific predictors. They also use 178 macro variables, so like interest rate, inflation, money growth, GDP growth, these type of things. Right. And 124 of them are from the FRED. So FRED is a database from the St. Louis Fed. Yeah, it's publicly available. And then they also use 8 equity premium predictors, so something like the dividend yield, which we also came across. Good. The data set that they look at are monthly individual equity returns from CRISP. So it's basically the same data set than in the previous paper from Kelly. The time frame is 1967 to 2016. Now, in total, they are going to use 10,000 stocks. In the last paper, Kelly Ju, they used 30,000. So the difference here is, although they start with the same baseline data, they are getting rid of all stock returns where a predictor is missing. So in the previous paper, they've been using the median across a predictor, if it's missing. And here these guys are more saying, let's be more conservative and just really use returns for which we really have an observed predictor. Otherwise, it gets out of the sample. Good. And they are comparing the performance of what I call their economic model relative to a kitchen sink prediction. So kitchen sink prediction is a normal term we use if some exercise is run based on using statistical approaches without much structure in it. Yeah? Like kitchen sink. It's like in German if you put all of your dishes into the kitchen sink without thinking much, right? Okay. So, and now we start already with the asset pricing theory, maybe 3 or 4 slides on that. So, before I go into that, I just want you to remind yourself that the price of an asset would be the expected price next period plus the dividend, and then we divide by the discount rate. That is kind of known from your BWL Grundlagenstudium and from our first 2 classes. What we now just do, instead of saying we divide by the discount rate, we want to make it mathematically more accurate. Yeah? So instead of dividing, we are multiplying, but it's the same impact that we want. We want a discount. So therefore this M here, before I really dive in, I want to give you this high level. The M is nothing else than the discount rate. And you see that kind of intuitively here. If you already divide MT, yeah, since it's the expectation as of T, MT, I define everything in a minute, but it's positive, non-zero, so we can just divide by it. So you basically see that the price today is the price next period plus the dividend, and then you're discounting it by this M, right? So that's all. Okay. Let's go systematically through that. Okay, but before, again, in terms of notation, SDF is the stochastic discount factor. So it's the M, because M will be our discount factor. It will be a random variable, so it's called a stochastic discount factor. Okay. Maybe just some history now that I think about it. The reason it got introduced, let's say, into textbooks around 2000 was that prior to 2000, you had a course in equity pricing, you had a course in bond pricing, you had a course in option pricing, and they all did some type of stuff with the discount rate. And then around 2000, the financial economists, they kind of realized that independent of the assets you look at, the discount factor should be at least modeled in the same way. And then it kind of got introduced. And then John Cochrane had the book about asset pricing around early 2000. During my PhD, we had like a paper copy of that. And that kind of then became standard knowledge in the literature. And now we have an asset pricing class at KIT. Here, this asset pricing concept, to my knowledge, is used the first time in such a machine learning predictive exercise. So it's really state of the art. And therefore, we are also introducing that in the bachelor's here, but as knowledge we need to understand the paper. Good. Let's really start. Okay, here's a definition. A sequence, so which means across time, of positive random variables, M1, M2, all the way to infinity, is a stochastic discount factor process if MT is defined as follows. First off, M0 is 1. Very intuitive. Yeah? If you get money right now, you don't discount that money. Okay. MT is bigger than 0. If I get money into the future, if it's 1 million, it's still worth something positive. But it might be worth maybe just a cent, or maybe it's worth 900,000, whatever. That depends on the MT. But MT is positive. And importantly, we define MT such that this equation holds. So we want basically that the intuition we have from the dividend discount model holds in a universal sense. Therefore, we say MT shall be defined such that MT times PIT, which is the price of asset I at time t, is equal to the conditional expectation as of time t of cash out, cash payments in the future. So here we write the, let's say, the dividend next period of the firm plus its selling price if we were to sell it. So that would be the cash out next period, and now that gets discounted by MT plus 1. So that equality has to hold. The way I like to read that equality is I divide by MT, and then I see that PIT, the price today, is nothing else than the expected discounted value of my, here in that sense, next period's payouts, discounted by the stochastic discount factor. Now, if you look at that carefully, first you see M has not an I index. That's very important for your understanding, because it's not asset specific, right? It's a discount factor. Connect back to the cap M. What determines the discount rate in the cap M? It's market risk, and then the beta exposure to it. Yeah. So kind of the analog of the SDF in the cap M world are these innovations to the aggregate market. So therefore, M is something that captures systematic risk. It will capture the risk-free rate, which is also aggregate. Right? One can connect the risk-free rate to GDP growth and inflation. And therefore, M also contains everything that drives the risk premium. And we know intuitively risk premium is driven by systematic risk, something we cannot diversify, although we have a well-diversified portfolio. So that's important. And you therefore see that was the unifying approach around these 2000s, independent of the asset I'm looking at. This might be equity. It might be a bond, which pays a coupon. It might even be an option contract. I should always use the same M, ideally. Okay, great. So that is our SDF. And why is it called SDF asset pricing? Because, just my last statement, if you found a proper SDF then the price of any asset class that you observe in the market should be explained by exactly that equation here. Good. What we now do in the next two equations is, or the next three equations, we are just working with this equation here. So first thing we do, we divide by MT, which gives us this ratio here, and we divide by PIT. So what we have is then this guy divided by PIT gives me the gross return, R. Yeah? Capital R is the gross return, so it's 1 plus, let's say 1.1. For a 10% net return, capital R would be 1.1. So here's now an equation that comes from that definition, which is called 1 equals the conditional expected value of next period's return of asset I multiplied by MT plus 1 over MT. So MT plus 1 over MT is the discount rate to discount a payoff that comes in T plus 1 back to T. Yeah? Good. Now that has to hold for all time periods T, and it has to hold for every asset I. Now that equation here is called Euler equation. And if you do some empirical asset pricing course, which we also offer in our department, there will be a lot of work around this Euler equation. Yeah, so it's very fundamental. So next thing we do is I want to connect back to the dividend discount model. So I go back to this equation here, the first one. I divide by MT, so therefore MT is in the denominator. P remains on the left-hand side. And what I'm now doing, instead of looking at the price next period, I look at some terminal period, capital T. So think about, for example, in corporate finance, if you value a firm, the typical way it works in M&A is, or in the IPO modeling, you model expected dividends for maybe 3 to 5 years. That's the cap T. And then you ask yourself, what's the terminal value at which I could then sell? And I'm rewriting now the above equation in that sense here. Now, what it gives me is that I see that the price of an asset viewed through the lens here has two components. One is the expected present value of future dividends. And the other one is the present value of the terminal value here. So what I could do if capital T goes to infinity, I here would have a sum that goes to infinity, which would really say the price equals the expected discounted value up to infinity. And then I would have an additional condition that this entire term here will be 0 for cap T going to infinity. Yeah, that is a no bubble constraint in the asset pricing class. But for me, it's important to show you and to connect back to our first case that the intuition that the price equals expected present value of dividends is universally true in our thinking. And what we do here is we are now more careful in how to model the discount rate, right? And the proper way to model is now using that stochastic discount factor. Good. Another thing which I'm doing is now I work with this Euler equation here to come to the last equation. So the first thing I'm going to do is you have here the expectation of a product, yeah, the M ratio times the R. So I want to spread out or compute out that expectation. So you might remember from statistics, the expectation of X times Y equals expectations of X times expectation of Y plus the covariance of X and Y, right? And that's exactly what I'm now doing here. So one more thing. The MT plus 1 divided by MT, that's this one period discount rate. Yeah? Because if we just have MT plus 1, it would be the discount rate from T plus 1 down to 0. And you see here the expectation is as of time T, so we want to discount only back to time t, which is the reason why we then divide by mt. So here we are really just having the discount rate from t plus 1 down to t. And that discount rate I'm going to call zt plus 1, yeah, just to get rid of the ratio. So it's the one period SDF, as I'm saying here. And therefore you could see if I'm interested in mt, let's say m2, that would be the discount rate from 2 down to 0. That would be nothing else than the product of z1 times z2. So what's the discount from 2 to 1 times the discount of 1 to 0. Good. So therefore here now I have an expectation zt plus 1 times rt plus 1. You do that computing out as I've just mentioned, and then you are computing out, or you are solving for the expectation of ri, which you put to the left-hand side. Yeah, there's a little typo here. That's why I've been saying it here properly. That's the conditional expected return of asset I. And since it's LaTeX formula, I couldn't change that so quickly into my PowerPoint. So I just tried to be accurate in the explanation. Yeah, but keep in mind, that's an asset-specific return coming from here, and that's its expectation. And what you now see is it depends on 1 divided by expectation of zt plus 1 minus 1 divided by expectation zt plus 1 times covariance as of time t, because these are conditional expectations, so it will be a conditional variance of the SDF and the return of asset I. Now, this looks strange, but just relax. This is simply the gross risk-free rate, this entire ratio here, as well as here. The risk-free rate, the gross risk-free rate will be close to 1. Yeah? So it's 1 point something, 1.01 or the like. So therefore, there's not much action coming from this one. The interesting action comes from this one here. So what do we learn here? We learn that the expected, if there is an SDF, and as a financial economist, we strongly believe there is an SDF. It's simply difficult to model, let's say, but otherwise it exists. And therefore, we know that the conditional expected return, put this to the left-hand side, that would be minus the risk-free rate. So the entire thing would be the expected risk premium for next period, is equal to minus the risk-free rate times the covariance here. So now we have an identity of what's driving the expected risk premium. And we see that the expected risk premium is driven by that conditional covariance of the asset's return with the stochastic discount factor. So said differently, the reason why asset I pays a premium is because it has a covariance with the SDF, which is non-zero. If some asset has a zero correlation, which implies a zero covariance with the SDF, also its risk premium would be 0. With regard to the sign, I don't say too much to that right now, since I do not provide further intuition on the SDF. But I want to say it's completely consistent with what you know from the CAPM. Because from the CAPM, you know that the expected risk premium of an asset I equals covariance over the variance of asset I's return with the market return. And the market return, I said before, is the proxy for the stochastic discount factor in the CAPM. Yeah? So the CAPM is a special case of the SDF asset pricing paradigm, so is the Farmer-French model and all of these other factor models. Good. One more thing I want to add for the intuition. Maybe let's ignore this last term here. Yeah? Let's think about the t goes to infinity. You see that a firm with a high dividend in expectation has a high price, all else equal. Makes sense. But now let's think about, you have two firms and they have the same expected dividends, but one of them is 10 times more expensive than the other. That could happen, right? And it happens, let's say why? Well, the expectation of the dividend is the same, I said, by assumption. The expected value of M must also be the same because it doesn't depend on the asset I'm looking at. So therefore, the difference why a price might be 10 times higher than the other price is exactly this covariance term between the SDF and the dividend. And that is something we are also seeing here. The covariance captures the risk premium. So if a firm is 10 times more expensive, it means that the risk premium is lower of that firm. Yeah, because price, going back to case number 1, price equals expected dividends divided by the discount rate. So if the discount rate goes down, the price goes up. Yeah, so once again, my point was, in the extreme, visualize two firms with the same time series of expected dividends, yet the prices are different. And that is rationalized by both assets pay different risk premium. Therefore, the discount rate is different. And the question is then, why is the risk premium different? Well, it's different because the covariance of the assets return with the SDF is different. And let me give this very last intuition. Why should it be different? You have to think about the SDF. You also see it from this equation. Let's say you have an asset. Again, let's say dividends are the same across two firms. So I change my example now. I say in the same example, expected dividends are the same. Okay. But I now change the example a little bit. I want to give you some intuition here for this M times D. So the point is, let's say someone gives you a dividend next period, which is $1. Okay. And next period is a super period for you. Yeah, kind of, you have great income, your investments do well. So what is that additional dollar worth to you? Not that much, yeah, because you are rich anyways. On the other hand, if next period was a very bad period for you, you lost your job, the stock market crashed, so all of your investments went down, and now someone offers you that $1, that's worth a lot to you. And that is how you have to think about this M times D. M captures how valuable is the payout at that point in time, and it's a random variable. So therefore, for each state of the world, you will have an M, and the more valuable a payout in that state, the larger will be the M. Right? Okay, we come back to that thought, but I wanted to raise it already here. Good. In general, on the first few slides, I will stay longer than on the last few slides, just for the time management reason. It's the last slides are more on the machine learning part. And since it's a financial data science, I want to focus more on this financial aspect, which is difficult for you, I think, to work on your own through that material. Good. Let's continue. We talked already about the Q probability, the P probability, and I said I will come back to you at the end of our course and provide some more intuition for that. So there will be more intuition to that exactly coming up. I urge you to have a look, if you work on the slides again at home, to have in parallel lecture 7 open. And I just made a screenshot of a few concepts we had in lecture 7, since it helps you to connect back. But first, some definitions. So we are calling a probability measure Q to be risk neutral, and that's exactly the Q we've been extracting from options. Yeah? The capital Q will be the CDF, and the little q will be the PDF. Okay. So the probability measure Q is called risk neutral if two conditions hold. Condition 1 is the probability of an event A is 0 if and only if the actual probability of that event is also 0. So we say both share the same null sets, and in mathematical terms, the buzzword is that Q is an equivalent probability measure to P. Yeah? The intuition is, if the actual probability of your house being on fire is 0, then also the premium for ensuring that needs to be 0. But as soon as the probability of your house be on fire is positive, even if it's just epsilon, then the price could be anything. Okay? So that the null set is the same. Good. And the second condition is about when I said it can be anything. So that seems wrong. Therefore, there's a second condition, yeah, which constrains it. And it says that SIT, so that's the price of S at I at time t, divided by S1t, which is the value of the money market account, which we defined in the previous class, that must be a Q martingale for every S at I. Good. Let's work with that to build intuition. Now, what is condition 2 telling us? Well, I'm just translating what it says into a math equation here, yeah? Because SIT over S1t shall be a martingale. We had that once, but doesn't matter, I just ignore it. So what does it mean? Well, it means that the expectation as of time 0 of SIT divided by S1t must be the values as of time 0. So it must be SI0 divided by S10, but S10 is 1. Yeah, because the money market account was 1 unit of currency times the exponential of the integrated risk-free rate across time. But if there is no time, because we are in 0, then we just have 1. So you see that we have seen that equation when we computed option implied information, but we haven't yet really talked about fundamentally where that Q comes from. And now we just see it's a definition. So historically speaking, I mentioned Merton and the Nobel Prize for option pricing. So he kind of introduced that concept, which at his time few people did understand. Around this 1998 was this Nobel Prize for that. So math finance already took up in the mid-1990s, right? And that was a concept and applications that the mathematicians brought into finance, so financial mathematics became part of quantitative finance. The financial economists, they still did not understand that well because they came from being oversimplistic from the financial econometric path where you forecast the P probability and the like. Yeah? This here comes more from the valuation part. Okay, so what does it say? It says that the price of an asset is nothing else than its expected future value discounted simply by the risk-free rate if we used Q as the expectation. Okay, let's work on the expectation here. The expectation is nothing else than the sum across all states of the world, which are little omega here. So that's one state element of capital omega, which are all states of the world. So you see here now the expectation stands for the price at time t at a specific state of the world divided by the money market account value in the future for the same state of the world, and then times the probability of that state of the world according to the Q measure. So Q is a probability measure, yeah? So it adds up to 1. But it can differ from the P measure. So therefore we just see that if we know the Q, one could compute the price today based on the price in the future. And what we have done in our course, we started with more advanced material relative to the way it gets introduced in a sequence of courses. So we've already talked about the Q quite a bit in lecture 7. In lecture 7, we talked about that the probability at time t that in tau periods from now, the underlying S is at value k can be computed based on the second derivative of either the call or the put. So here I've been using the put formula, and I'm also posting in here from lecture 7 the implied volatility surface for k being close to 0. Yeah? So we had these very high implied volatilities at out of the money put options, that translates into relatively high put prices, if we compare that to K being at the money, which translates into a pretty high Q. Yeah? And here it would just translate that if you have an asset, SIT, which in these states of the world, visually in the picture, where the market, let's say, crashes, so SIT, where the market crashes, if SIT was to pay a lot, then the value of SI0 would also be all else equal high, because the Q for that state of the world is large. And we had already intuition that investors want protection for these crash risk scenarios and are willing to pay a lot for that, which translates into Q being high. And here we would see it also translates all else equal that an asset which pays out a lot in that state would also have a high value. So I think it's beautiful to see this connection of implied volatility surface and equity valuation. That is a big learning point which not many people have. The other thing I want to visualize is the Q density from the ECB report that I've introduced in lecture 7. Yeah, so that is the probability density function for a specific day of an index option. So if I were to price or state the price of the index as its future values, I would use exactly also that density here for computing the expectation. So in that sense, you might see why the quant finance people kind of like that Q, because Q is observed, which is really cool. And it's very strong. It's not just cool, it's very, very strong, because working with something observed leads to less errors than if we need to estimate it. Good. Now we come to the next box and the next accomplishment, assuming we understand that. If you go back to our first two courses and now this third last course, we basically have come across two ways of computing the price of an asset I. The first one is this traditional, I call it dividend discount model, or from now on, we call it the SDF pricing. Because the price of asset I in time 0, which I like to do for today is 0, is today's expectation of all future dividends discounted by MT divided by M0, but M0 is 1. Yeah, so I just put it in so you connect back easily to the first equation of that slide. But you keep in mind this one is 1, so you just have really expectation of DIT times MT. Now that is the fundamental way of pricing in a way. Yeah? The reason we call it fundamental, we can build financial economic models that connect the M to the utility function of the agent. And the dynamic of M is connected to the dynamic of the economy. So it's very fundamental. Now on the other hand, by defining a Q probability measure, which connects to the vol surface, basically, we have a second way to determine exactly the same price. And that says it's the expectation under Q of future dividends and now discounted by the risk-free rate, because S1 is the money market account. Yeah? So S10 would be just 1, and this guy here is e to the r times t, if the r is risk-free. So therefore you see we have here e to the minus rt, basically. Yeah? So it's a risk-free discounting. That's why Q is called risk-neutral measure, because the discount rate is risk-free, but coming up in a minute from now, the risk premium that we know is part of the price, it's embedded in the Q. Yeah? How do we know? Well, we just know that P and that P must be the same. And we know that in this P here, we have a discount rate composed of the risk-free rate and the risk premium. So of course, the right-hand side here must also account for a risk premium, but we don't see it explicitly. Yeah, it's in the Q. And that's what I want to work on now here. Now this last equation here, these two, imply the following. If you do what I've done here, you just write the expectation as the sum across different states, and then you multiply in the probability, here the dp and here the dq. And then you see the d is the same across both equations, and then you just think about what's different. And you will see that here you have mt times dp equal to S10 divided by S1t times dq. And now I just solve for the m by dividing by the p probability, and that's what I had been doing here. So you see that since both pricing equations are correct, we now have a restriction or additional intuition of what mt captures. So mt is the value of the SDF as of time t for state omega. And we see it has two components, or two ratios, which are multiplicatively connected. One is dq divided by dp, and the other one is S10 divided by S1t. So that here is simply e to the minus r times t. So it's risk-free rate discounting. So therefore we know the SDF captures the time value of money. Simply money that comes in the future is discounted by simply time value. There's not a risk premium to it. But then we have a second component, and that is the ratio for every state, here for state omega, dq versus dp. That's my fire insurance example again. If the probability of being on fire in that state is 1%, but the insurance charges me 3%, then my premium is 3, yeah, factor 3. Or I might have mentioned a paper, the probability of a crash risk. It's difficult to estimate, but let's assume we properly estimate that. These probabilities are usually also pretty low, but the probability of these crashes as priced into the vol surface are pretty high. Yeah, that also kind of tells us there's large risk premia for a particular state, and the state I was looking at is the state where k is close to 0. Yeah, somewhere here. So once again, what's the bottom line? The bottom line is now intuition for the SDF, that the SDF accounts for risk-free rate discounting, but it also accounts for risk premia, which is the difference between the Q and the P probability measure. And I copied out a sentence from the ECB paper, which we discussed, just for your convenience again. And it says, the risk-neutral density, so the Q, of an equity price is the market's estimate of the probability distribution for the future level of that equity price, adjusted for the presence of investors' risk aversion. Yeah? So they are saying Q is simply P times some risk aversion adjustment, and risk aversion translates into risk premium. And that's exactly also what I'm saying here. Yeah? That the ratio of Q over P is a measure for risk aversion, measure for risk premium. And therefore you see, if we do SDF discounting, the SDF as a discount factor accommodates risk-free rate discounting and risk premium adjustments. So that last pricing equation also implies, and now I'm simply solving for the Q in this equation here. Yeah? I'm just saying dQW equals, so this goes to the other side, so I have S1t omega times S10. So this would just be e to the r times t. And then I have mt of omega times dp of omega. So the notation is because just yesterday I added these little d's. Originally in my LaTeX I have it as q, but since I work here with dq, and in this lecture here we explicitly had the little q here, which in my old lectures I didn't have. So therefore I had to adjust the language in the notation bit. which makes the notation a bit, so I say it a second time. That's the PDF under Q for a state omega, which consists of, if you want, two parts. Yeah, one is the blue box, which is the risk-free, it's the money market account, so just e to the r, times dm. And here I'm adding, that's also called the blue box, the Arrow de price of a state. If I had more time in my classical way, I'm introducing that, but that's at the master's level. I take more time, we come from stochastic calculus part. Here I don't do that, since our focus is on the data science and the machine learning applications. Yeah, but still, since you might want to use the slides for reference if you take future asset pricing courses we have at KIT. So that guy here is the Arrow de price. I want to share the intuition. It has the intuition I mentioned before. If omega is a state of the world where you really desperately need some money, then the MT omega would be large, right? It just means what's the present value of, or what's the present value of a dollar received in a particular state. And the price of that is the Arrow de price. Arrow and de were two microeconomists who introduced that notion, I'm not really sure, 1960s, maybe even 50s, I don't know, yeah, but let's say 1960s. So let's connect back. What's the intuition there? We therefore learn something about this Q measure, because we see the Q measure has two parts. One is the actual probability. So if something is more likely to happen, all else equal, it also has a higher Q. And the second dimension is independent of the probability of something to happen. If the state is like a state of emergency, then MT will be large because a dollar you receive in that state has high value to the investor. And then also Q would be large. And that's this risk premium channel, the last one, basically. So again, intuition from our lecture 7. After the 1987 crash, people realized that within a day, a well-diversified index can drop by 20%, by 30%. Now they want protection, especially on a Friday they wanted protection, or before public holidays, because they can't trade to new information, and which means for these states, M will be pretty large, and therefore all else equal, you see that the put options become pretty expensive for these very low strikes. It's not because P is changing, it's simply because the perception of M, I say perception because M is driven by risk aversion of the investor. It's something about how they perceive the severity of the state omega. And if that perceived severity increases, so does Q. And therefore, I like to think in terms of the dq omega to be the value of a state, or, that's my favorite, the cost to hedge a state. Because that connects very nicely back to our options. I buy a put option with low K because I want to sleep well in the state of the world where K is low, right? So I'm hedging that risk. But that hedge has a price. It's the put option. And the second derivative of that put option is the Q density. Yeah? And therefore I see that the price directly of the hedge translates back to these probabilities under Q. Good. 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 And in mathematical statistics, the ratio of two densities, so here dq over dp, is called the Radon-Nikodym derivative. Yeah, we will not need that, but just for completeness. Okay, just a pure footnote. In machine learning, you might come across something called like the Kullback-Leibler divergence, which is similar in spirit. It tries to measure the distance of two probability densities. Right? And here we see the Radon-Nikodym derivative is also the distance. And just mathematically, it's very accurate because it's state by state, the distance. While if you compute something like this Kullback-Leibler divergence, you take the expectation of the distance. So we had a project there with some students trying to compute the distance of probability measures on a state-by-state level rather than just on the aggregate. Okay, well, that was a footnote. Good. How are we doing time-wise? Yeah. Good. Any question to that? Because that's the core of the paper. Okay, sounds good. So let's continue. I'm basically providing here intel in order to better understand the machine learning application which is going to come up. Good. So we stay in the SDF asset pricing, and now we go towards estimating asset pricing models. So empirical tests of an asset pricing model. What's an asset pricing model? It's something that has to do with the discount factor M. Yeah? So such a test relies on unconditional tests. Now this assumes that random variables have a stationary distribution. We kind of already talked about that. I want to learn the stationary distribution, so I need a long sample basically to have observed everything that could happen with the probabilities that are accompanied. And here we also assume, that's just interesting to keep in mind, that distributions are ergodic. Because you have seen in the previous equation, the expectation is with regard to the path. While in statistical testing, we do expectations across time. And they don't need to be the same, right? But they will be the same if the distribution is ergodic. Okay, we can't really test for that. Therefore, it's important to keep that in mind, because it might be the reason why something doesn't work in reality. But let's stay to the text here. So we assume stationarity and ergodic distributions, which then ensures that the sample average across time converges to the population mean, which is the expectation then across states. Good. So if we want to test that hypothesis here, that's how an asset pricing model is tested. Because the asset pricing model implies an SDF, here written as the one-period SDF, and then you have these realized returns for different assets I across many time points t. So if you take the conditional expectation of that product, it needs to be 1. So that's an identifying restriction to help you identify your Z. Good. So that's the conditional test if you were to run this, because it has a conditional expectation. If you apply the law of iterated expectations, so it's if you take the unconditional expectation of the left and of the right, then you end up with the unconditional expectation of this guy here, due to this law of iterated expectations. Now, the first thing you note is the structure of the expectation looks the same, whether I work with an unconditional or with a conditional expression. That's good. Because ideally, I like to test that, but because of data limitation, I need to run an unconditional expectation across the full sample, which is not a problem, but there might be a problem coming up. And I have this here in the box. The conditional expectation has a much stronger consequence than the unconditional expectation. Namely, you see here, I could multiply in here any IT, which is a variable known as of time t. And I can also multiply to the left-hand side, because it's the expectation as of time t. So IT cancels out left and right. Therefore, I can just multiply it in. But if I multiply it in here, and now I take the unconditional expectation, you see that that relationship now stands here. The IT cannot be cancelled out anymore, because as of time 0, it's random. So therefore, what the author correctly then argues is that it's not sufficient to simply test a model for the SDF using the unconditional, which many people did in top research, but we have to use this, I call it extended expectation, where we are multiplying in potentially any type of IT variable, which we just call instruments. Okay. Good. Now we continue on that thinking. So how to test now a conditional asset pricing model? Well, the point is we aim to test such a conditional relation, but we can only conduct unconditional tests. As of now, maybe in your generation, there will be methods, or you come up with something that you can still test whether it holds for each time point. But as of now, we need this law of large numbers across time, so we need the unconditional expectation. But at least what we should be doing, we should include instruments IT, and then to ensure left-hand side equals the right-hand side. So in that sense, the unconditional test gets closer to the conditional test. Good. So the power of that test depends on the choice of instruments. Because it could be that a specific set of I makes that relation hold, although there are other I's where it doesn't hold, but just the researcher doesn't show that, right? So you want to test that for any type of I someone could come across. Good. The paper has a nice idea how to do that. So of course, I'm increasing the question marks, but there will be a resolution of how that can be done. But you kind of see the difficulty. Usually how it has been done in empirical finance is people are looking at the Pharma French website. They have like 5x5 or 10x10 test assets, and they test their model on these test assets. And basically the author here says this is too limited, right? Which of course it is. Okay, super. We are nearly done. We are getting close to the machine learning. Now let's think about the one period SDF versus an affine factor model for factor returns. I already gave you this intuition at the beginning of class. CAP-M is a special form of SDF. So it's Pharma French. And now I want to show you two equations for that. Now, in all of these affine, usually it's called linear factor models for expected returns, like Pharma French or the CAP-M or any of these other factor zoo models, the underlying assumption, if you were to connect that back to the SDF, is that the SDF ZT plus 1 is affine in FT plus 1. Right? So ZT can be anything if you assume it is linear in factors, then these factors would be driving the SDF. And therefore, these factor variations would be variations in your discount rate. So here's an example. Yeah? If we say that f is a factor in a linear factor model, then here's a definition. Then it means the difference of ft plus 1 minus its conditional expectation. So these are the innovations in f, like innovation in the market return, yeah, within the CAP-M. Now that innovation multiplied by some parameters which are known as of time t would be my SDF. Let's have an example. Let's say in the CAP-M world, that would be the return on the market, and this would be the expected return on the market. Now let's say the return of the market next period is lower than expected. So we have a crash. So this guy would be negative. These other guys are here positive. So therefore we have a negative multiplied by a negative becomes a positive. It says the SDF is large when the market crashes. Exactly what I said before, right? If the market crashes, it's a state of emergency. So every dollar an asset gives you in that state has high value to you. Yeah? So the SDF would be large in that period. So everything is consistent. And in general, we have this relationship here that the expected return of asset I in a conditional beta pricing model, so in a linear model for expected returns, has that covariance shape here with xi and psi being known as of time t. These processes exist. they don't bother us right now, since we are just on a conceptual level, but you could treat the xi-t as being the gross risk-free rate. Yeah? So if you bring that to the other side, you see that factor models who assume that the risk premium depends on the covariance of the return with some factors do implicitly assume that the SDF is defined this way here. Good. The reason I think this is mentioned is that the stock return prediction literature works most with factor models. Now this paper here works explicitly with the SDF, and it therefore wants to bring everyone on board and repeats these ideas which are also mentioned in asset pricing textbooks. Yeah? But the paper explains that well, so I took it from the paper here. Oh, sorry. Good. So notice, the hypothesis that there exists a conditional beta pricing model with F as being the factor is equivalent to the hypothesis that there exists adapted processes, Xi and Psi, such that the SDF is defined to be a function of these factor innovations. Good. So therefore it continues, if we want to test for every asset I, every time point t, that such a predictive relationship exists, right? It's predictive because we want to do a one step ahead prediction, and the covariance term, the psi, the xi all have a t index, so it's predictive. So if we want to test whether this predictive relationship holds, we should test the corresponding SDF representation. And what is the SDF representation? It's here, that the SDF Z is given by this expression here, which you see here. It's 1 divided by xi, 1 divided by xi times psi, this guy here. So this guy here is the SDF. Then you have Ri, which multiplies the SDF. I go back a slide. Here, this comes from here, yeah? SDF gets multiplied, or let's say here, SDF gets multiplied by Ri. We have that here, SDF multiplied by Ri. And then we also have the IT here. So he brings the expected IT to the left-hand side. Everything is then written within one expectation operator. And that's what he has here. Yeah? IT times ZT plus 1 times RT plus 1, and then here minus 1. That's the IT expectation from the right-hand side. So therefore, what's the bottom line? The bottom line is if you want to test whether F is the proper factor pricing model, then you should be using the SDF representation, and you should be testing this equation here. And there is another highlight of what has been known already, that that previous test is a joint hypothesis. So it basically tests jointly that Xi and Psi are correctly modeled, as well as that this relationship holds. So it's a weak thing, that's a joint hypothesis, right? But it's what it is, so we just highlight it. Good. Why do we do that? Because the machine learning approach will work with this equation here. That's why we went through that. So if there is a question, then now is a good point to ask the question. If that's not the case, then I just continue. So, how does learning work in a nutshell? Good. The learning works in a nutshell that this paper works or embeds the machine learning predictions within that Euler equation. And that's the economic structure it imposes. And the previous papers I've discussed last class, they didn't do that. They simply did, like we predict an AR1 forward, they just used more machinery. Right? But this guy now says, let's be more close to, I added that, domain knowledge. We know that if there is an SDF, which we strongly believe there is, then the modeling this has information about expected returns, because we've rewritten that in terms of the covariance. So we therefore really see that expected returns, maybe I go back since I see some nodding in the class. If we go back here, yeah, we see that if we want to predict expected returns, the SDF and the covariance might have information for that. And that information was not considered in the kitchen sink approaches. Good. So, in a nutshell, but we go in more detail to it. The learning works that here the SDF is used as a quantity of interest and itself will be modeled as a neural net. And that goes well along with the class we had maybe 3 weeks ago, that the neural network is a function approximator. And that is what you should take away here. No? For now, you might have thought neural network is good for prediction. Here, become sensitive, the neural network is a function approximator. And the researcher here needs an approximation for this function, which he doesn't observe. He just observes, if anything, the expectation of the product. So therefore, they will be using a neural network. In addition, you see the value of our class. We talked about latent states. So you have already intuition, a latent state is some random variable which is important for the target, but it's unobserved. We talked about Kalman filter, which we don't need here, but the intuition is kind of the same. Yeah? We have some latent states, and what they are going to use is, we know that the SDF consists of aggregate risk, systematic risk. So one driver of the M in the model will be these 180 macro variables. But in the best specification, they don't plug in these 180 variables and feed through a network, although we will see results, but we will see it doesn't work. But instead, he will first identify 4 latent states, which represents information of these 180. Yeah? So it's a dimensionality reduction, and we will see in the output it works much better. And they will use a recurrent neural net and an LSTM. I do not go into that detail because that is a full, I would need 2 or 3 additional classes. Yeah? But the idea is you either had or you will have machine learning classes, and here I show you how machine learning is applied onto financial data, and that then hopefully allows you to have examples in mind when you come across these approaches. Or next semester, we also for bachelor students offer this research module where students can work a full semester on a research project with the help of the PhD student. Okay. And in addition, we will see that the RI here, you remember, there will be the instrument also embedded left and right for the unconditional test. So what these guys are doing is very nice. They are saying we will have another network that will decide on the test assets in a very mean way. We will not say we take the 30 pharma French that we can capture, but we ask the neural network to find test assets that we cannot price well. So this is really how a researcher likes to do that. That's really beautiful. And connecting to computer science, that will be an adversarial generative artificial neural net, because we have 2 neural nets which work against each other. We have one neural net for the SDF. It wants to reduce the pricing error. At the same time, we have another neural net that picks these instruments IT such that the SDF can't price them. And then they're competing with each other until there's an equilibrium, an internal solution where no better solution can be found. So it's really beautiful. And what's also beautiful is the training. Look at that. They train from 67 to 86. They only use 5 years of validation, and then they use the full 25 years without retraining. That is really impressive. Relative to the state of the art from last class, where they retrain every year. Right? We kind of know if you have a neural network, it interpolates well, it extrapolates not so well, hallucination. So therefore, with a simple kitchen sink, you have to relearn all the way. So differently, you don't want to extrapolate too much. But here, they're really confident by just training once and then let it run, the forecasts. I think that for me is like the state of the art, that a model should be able to work, because if you learned the stationary distribution, then you don't have to relearn. So that's, okay. What's the time doing? We're always time constrained, naturally, by doing finance and data science, but we do it. Let me add some more details on the learning framework. Basically, so far, for the last 1 hour, I've talked about this equation here. Now, there is an equal 0, not equal 1, so what does it mean? It simply means previously we had the expectation of m times r. Oh, I see, there are two differences. I just copied it from the paper. Here you wonder, where's the mt? He has a slightly different notation than my previous one. His mt plus 1 is my zt plus 1. I just, since I teach it the first time, this paper, I realize, oh, I don't have the PowerPoint open, but I need to make a comment, add comment. Okay, then I have to remind myself and redo it on the PowerPoint later, right? But that here is the one period SDF. It has to be, because he's not dividing by anything, yeah? So, yeah, I don't know. Wait a minute. No, it's not. Wait a minute. MT plus 1 divided by MT. Maybe we just work on the excess return, and then you see you can multiply the MT towards the 0. Yeah, so I think it's fine, because his notation is explicit the way I had it, that MT plus 1 is the strictly positive SDF, so it must be the accumulative discount rate. So I think I got too fast here. So RE is the excess return, yeah, over the risk-free rate. Therefore, if you rewrite the Euler equation in terms of the excess return, the equal 1 disappears and you simply have equal to 0. I'm not deriving that, so we just take it as given. But on the YouTube channel of the chair, we have videos where we go through the analytics. But in that course, I don't need that. But I just want to mention this comes from the Euler equation. So since we divide by MT, we can multiply by MT, so MT disappears against the 0. Okay, everything is as discussed previously. Okay, so that is then equivalent to something we have seen in my previous introduction, that the expected excess return is driven by the covariance of the excess return with the SDF. And here it's in addition multiplied and divided by the variance of the MT, which cancels out, but it's kind of used. We don't need that for the machine learning, it's just for the intuition to connect back. So the expected return of an asset has these two components. One is the market price of risk, which if you go fundamental, connects back to the variation of the SDF, kind of like the variance of the market return within the CAPM. And then you also have the beta exposure, computed like we would compute a beta. But here the risk factor is the SDF. Yeah, so beta times market price of risk gives me the equity risk premium for S stock I. And that's equivalent to coming from the SDF pricing here. Good. Now we move towards the modeling. Now in the paper, it is assumed that the MT plus 1 is 1 minus, so the 1 is not important. The minus is kind of important for the intuition, because we had seen always it's minus the covariance, so therefore they put the minus here, and then you have WTI RE T plus 1I. So basically it's assumed now that the SDF is spanned by traded assets. Right? If you want to improve the paper, that might be something you want to improve, but for now that's how he makes it actionable. Because we know SDF is unobserved, but now at least we know, we assume it is partially observed because it's a function of excess returns which we observe. But what's not observed are these, what we interpret as portfolio holdings, and that is something which will be modeled by a neural network to make this equation hold. Yeah, so I give you here my summary. Pelger assumes SDF is spanned by tradable assets. And another intuition is that Pelger treats, therefore, this guy here as the factor F. So that's how he makes the connection back to the factor models. Because we have seen in Pharma French, CAP-M, these are all tradable factors, yeah? Market, size, value, long-short portfolios, all tradable. And kind of Pelger generalizes that by letting later the neural network determine the W as a function of the R's here. Okay, so now if you price an asset with the SDF, you can be sure it's arbitrage-free, the market. So if I can price all the stocks with the same SDF, arbitrage-free as equity market. If I also can price bonds and options in the same model, then I know I'm arbitrage-free. Because different prices will only be different because expectation of dividend is different and of that covariance SDF with return. Yeah, we call it arbitrage-free market. And that arbitrage-free market here will imply that the excess returns of an asset I are driven by two components we have come across in our class. One is the systematic movements. Think about the CAP-M. F will be the market excess return. That's the beta of the firm. So systematic movements. And then we have the idiosyncratic movements. Yeah? So therefore, the fundamental problem from an economic point of view or financial economic point would be that in order to identify the asset pricing here, we need to identify the portfolio weights W that model the SDF, and we would need the risk loadings beta. Because we know from the CAP-M, only systematic risk matters for the premium, right? And therefore, this is here this intuition that the beta and the W are the underlying forces that make or that connect this machine learning approach to financial economics. In this machine learning approach, you will see in a moment the beta doesn't play a role. So it's more here for intuition, yeah, how it connects back. But the W will play a big role. Good. Now comes more details on the learning. Okay. So that's taken from the authors, right? That's why it's called we. So they use an adversarial approach, this is this min-max, to select the moment conditions, which means these instruments that lead to the largest mispricing. Before I go to that, bless you, you might have seen the GANs have been in the news, I forgot, maybe 3 years ago. There's this one nice application where you let a computer learn to draw like the Mona Lisa, right? So, and the idea there is you have one network that tries to draw, but it just starts purely random with the strokes, and you have another network who tries to say it is the Mona Lisa painting or it is not. So you have this discriminator, and because of this joint interaction, the drawings of the Mona Lisa from the computer became very good, hard to tell apart from the real one. And here it's a very similar intuition happening. You see here, we are in our SDF pricing, because the SDF was the expectation of the SDF times the excess return must be 0. That's conditional. For the unconditional, we would have the IT in here, yeah? And therefore it's the unconditional expectation. So what the paper is doing, therefore, is first, the unconditional expectation should be 0, so therefore the 0 is not shown. You know it will not be 0, but you just try to minimize it as close as you want to 0. No, not as you want, as close as you can. So here he takes the second, the L2 norm. You could use another norm, but L2 is kind of what most approaches are doing. So it's like minimizing the variance of the prediction error. And instead of the instruments directly, he plugs in an additional function here, g. And the objective function here is that you want to find an SDF, which is the W, which will be approximated by a neural network. So you want to find a network that minimizes the pricing error, but you also want to find a G, which means instruments. Once multiplied with RE, it becomes kind of a portfolio of specific returns. Yeah, you could think about R as a vector. If G is just 1 and then 0 otherwise, you would just pick up the first asset. If it's 1, 1, you pick up the first 2 assets as a linear combination. Yeah? And that way G can be very flexible. So you want to find, or let's assume G is also modeled by a neural network, you want to set up or find the G parameterization that is maximizing the error. Yeah? And by this min-max, we are really in this generative GAN, in this GAN min-max intuition, and I have the intuition written down here. The asset pricing modeler, which is the min-max person, it wants to choose an asset pricing model, therefore an SDF, with a low pricing error, while the adversary wants to choose test assets G under which the asset pricing model performs very badly. And then the hope is that you are figuring out an SDF which prices well even for the worst possible G that someone could come across. Okay. Now IT and ITI, we will talk about that coming up. These are observed random variables. So ITJ would be some information about asset J, and IT would be some aggregate information. Okay. So, okay. I'm adding a few more details. First thing, you might wonder, currently there are assets traded, let's say at 2016, that did not trade in 1980. How to cope with that, right? So, also differently, within the training set, there might be stock returns which disappear or which come. So what he's doing then, and I think that's something you can generalize to other approaches, he's kind of considering all the time points at which a return is observed, but then he's rescaling. So if you observe within the training set a stock only half of the time, then the TI over T would be half. Yeah, okay. Otherwise, here's another way to think about the objective function. You have an implied loss function for your SDF, and it assumes that the adversary has chosen a G hat function and that you agree on the input features that you use to model the G in the W. Okay. So that thing here in the paper is called an SDF network. Yeah, so it's kind of the neural net for the SDF. Okay. So therefore, for a conditioning function G hat, which again will be driven by its own neural net, and by choosing the information set that affect the portfolio weights, these are the ITs and ITI, the neural net is going to minimize the loss function given here. Good. And the neural net itself will be modeled by a feed-forward neural net, yeah, for this W, the portfolio weights. Good. A few more information about the G. So we construct the conditioning function G hat, so that's for the test assets, via a conditional network with a similar neural network architecture than it's used for the SDF. So the conditional network serves as an adversary and competes with the SDF network to identify the assets and portfolio strategies that are the hardest to explain. The macroeconomic information dynamics are summarized by macroeconomic state variables, HT, which they obtain beforehand by a recurrent neural net with an LSTM. So kind of the recurrent neural net helps to identify the states, and the LSTM is like a prediction forward then for the HTs. So the model architecture is summarized in figure 1, which we will talk about. Okay, so that is the key picture. So let me see, what's the next slide? There, okay, so I think 5 more minutes for the first class, so we spend the time here. So that is, in a nutshell, their learning framework. So let's first connect back to what Gu, Kelly, Ju were doing last class. I talked about that. They've been basically using excess returns of asset I, roughly 6,000 per month, and then they've been running different supervised learning models, reinforcement learning, linear model, neural network, which used predictors as of time t to make these predictions into t+1. They take the average across all times and then want to find the model parameters that are producing the lowest pricing error, squared pricing errors, right? This is kind of the state of the art, let's say, from an econometric perspective, and this is the perspective if you use the economic structure, the SDF. It's more involved, but we saw already last class, more involved doesn't mean it works better. Yeah? But it works better, therefore it's useful to think what they are doing. So first of all, green and red are two different networks, and you see they will be connected. That's important. They are not independent of each other, they affect each other. So maybe we start here with the top network. So IT, I1, these are our features. These are features which do not depend on asset I. So these are these 178 macro factors and the dividend and the equity return predictors. These 8 risk premium predictors and 178 macro predictors. Yeah. So it's put into a recurrent neural net to back out the states HT. HT is then also fed through an LSTM in order to get the expectation of the age next period. And then they are modeling now the W, which is the portfolio weight vector that goes into the SDF by a function, or by a neural network function, feed-forward neural net, that depends on the HTs. And then, interestingly, also by the asset-specific features. Now, if I had done that myself, I would have been unsure whether or not to do it. So I think that's the learning point, just try everything. Because we learned that the W, the SDF, should not depend on asset-specific information, right? But I think it seems to be important to have it in. That's why it's in. So that's interesting. And that constructs the SDF. Now the SDF needs then to be contrasted with the G times R. And for the G, we now have the second net. And there we put in the same aggregate macro factors to also compute some latent factors. And these latent factors, they can be different in age. Why can they be different? Think about it, I might mention that. And then it also uses the firm-specific information. So the adversarial basically can now determine the parameterization for G hat. And they are both then, they meet each other once you compute the loss function. Yeah? Because the loss function, I go back, not forward. The loss function here, you see, it depends on the SDF as well as on the G. So that's the connection of both networks. And what I also like is it's very much already an end-to-end, what's called end-to-end, right? Because end-to-end means you just get input data and you have an output, ideally a decision to make. Here we don't really have a decision. But if you go to an asset pricing class, you will learn very early on, or you ask GPT, that the Euler equation is the result of a portfolio decision. Yeah, so the Euler equation is the first order condition to an investor who asks how to allocate my assets optimally. So in that sense, a decision is kind of implicit in there. And what I like here, and we see that in more advanced machine learning approaches, that maybe I do it from here, from the next one here, that this feature extraction is part of the full learning. Right? It's not feature extracted first, and then you do machine learning, like we usually would do, first the PCs, and then you run a prediction. But the extraction of features is allowed to be distorted if it helps to minimize the objective function. So I think this is something you should take away with, because that is very general. It's generalizable to other problems, and that's how you should do it. Right? You should allow, because if you think about HT as like a PCA, you could think about, I take my macro, I run PCA, and now it's fixed. But by not treating it as fixed, but allowing it to deviate from a classical thing like a PC, you allow that your decision implied output informs you about what these features should be. Yeah, maybe I make too much of a story of it, but I don't think I do. Because the point is, in the classical kitchen sinks, they don't do that. Right? They do feature first, keep it fixed, and then they run it. And I wonder myself how important it is to let the feature selection be determined by the objective function itself. And we will see that in reinforcement learning. It's always completely connected through end to end. And that's the gold standard. We know it from driving the car, flying SpaceX, these type of things. It's all end to end. Yeah? And this already, although it's a supervised learning task, it smells a lot like end to end. The paper doesn't talk about it that way. It's just my interpretation. And we will see the paper works pretty well relative to just using a neural network to forecast forward. Good. Oh, 2 minutes too late. So we have a break, and then